Good morning. For Traders Exclusive, this is George Tkachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. What I'd like to talk about this morning is equity markets and the yield curve. So let's just take a step back. Equity markets are doing quite well, digesting the gains they made off those May 4th lows. And we have the Dow flirting with the 25,000 level, kind of above it, a little bit below it today. Same with the S&P 500, straddling that 2,800 level. We'd like to see it trade above it, but it's just retesting that level. That's doing pretty well, and the Nasdaq's above 7,800. Now, as earnings season gets underway, as I told you last week, earnings are projected to be quite good. And some people may argue that perhaps a lot of the tech companies, growth companies, are overvalued. That's to be seen. Value is just someone's opinion in their eye. But we'll just take a look at how the market handles it. But one of the things I want to talk about is the yield curve. The yield curve has been flattening a little bit. And so if you read the financial press, they're talking about the yield curve is going to go invert, and that's going to cause a recession, et cetera, et cetera. Well, nothing at this point could be further from the truth. We're nowhere near a recession, and if the yield curve did invert, we still probably have at least a year until that recession hits. But all the other macroeconomic data is so strong that it's probably pretty much unlikely. But we need to take a step back is what causes that yield curve inversion. Typically happens when the Fed pushes up short-term rates too high, and investors feel that the Fed's going to have to loosen up, so they push down the longer-term rates. And that's what causes the inversion. However, even if the Fed continues raising rates now, they're not tight. They're not tight at all. They could do 2 more rate hikes this year, 4 more next year, and they're still not going to be tight because the economy is acting very strong and banks have lots of money on their balance sheets. So with that, right now, there's an opportunity here because the financials, especially bank stocks, have not been doing well. They've been beaten down pretty badly because everyone sees this yield curve kind of flattening or near inversion. However, what I think is they're missing the point here. Banks typically rise in a raising rate environment, but we need to have a upward sloping yield curve. We don't have that. But there was a very similar situation back in late 1994. The same thing, it looked like the yield curve was going to invert, and it didn't because the economy was very strong. What happened was the long end of the curve ended up going up, and banks pretty much went on fire. Of course, so does the rest of the market. However, at this point, now this isn't a buy recommendation, a lot of these banks that are beaten down are kind of coming through support levels, and there could be screaming bottom fishing opportunities. More specifically, I'm talking about Bank of America, that symbol is BAC, JP Morgan, that symbol is JPM. We could look at regional banks like Regions Financial, that symbol is RF, or Comerica, CMA. These are just some ideas, not buy recommendation. Consult with your financial advisor. But the whole point is the market may have mispriced these banks, and the yield curve straightens up. I might expect to see these banks fly. Now, as always, this is an opinion. Let price and volume be your guide. If you watch price and volume, it'll tell you if this theory of ours, where the yield curve will not invert, banks will straighten up and move higher. That's all to be seen, but price and volume will tell us the story. So, as always, have a great trading week. This is George Tkachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago.